Hello, hello, and welcome back to our talks about crypto and topics that are pertinent to you. My name is Sim, as always, like a little SIM card. I guess I should change that. I'm a Sim like the Sims game, one of the Sims in the Sim game, but I'm actually real. I'm not a simulation. So today I really wanted to touch on a few different topics. So it is going to be a few important things that I really think everybody should know when it comes to crypto. It's going to be a little random. It's going to be a little shooting from the cuff, but I think it'll be beneficial. So when participating in this market, there's a few fundamental things that are really, really good to understand in a really deep way, or at least have a good understanding of how they apply to your journey throughout the crypto markets, right? So one of the first ones is going to be the fact that most people think that these markets and participating in this market is a game of picking the right coins and then, knowing when to pull it out. That's actually not the majority of it. That's a smaller amount of it. The bigger piece that you need to understand in order to be successful in these markets is the psychology that's involved when it comes to markets. So a lot of times people think, psychology? What do you mean by the psychology involved in a market? What does psychology have to do with me putting money into an asset or me putting money into cryptocurrency? But actually, especially in the cryptocurrency market, the psychology involved in the process of investing is one of the biggest reasons why you will either make money or you will lose money in this market. So how is that? When you're looking at the price of Bitcoin spiking the way that it does, have you ever thought about why it's doing that? And then if you were to run some analysis on it, why is it doing it every 4 years? What are the factors behind it, and why is it like clockwork, and why does it become predictable in many in many different ways? So the reason why Bitcoin spikes every 4 years is because the code that runs the blockchain called Bitcoin has a property inside of it called the Bitcoin halving or the Bitcoin halvening. What it says is every 4 years, half the Bitcoin will be produced. So if half the Bitcoin are going to be produced and it's predictable on which date that's going to happen, then it makes a lot of sense that after that date, the price of Bitcoin will go up. And that's why it does. Like clockwork, it goes up every 4 years. So now let's back up even from there. Let's zoom out and really get down to the details of it. Like, what is Bitcoin? What is that code that's running on there? So for you to understand that, you really have to understand the idea of blockchain. What is blockchain? Blockchain is the idea that you can run a bunch of computers across the world, kind of like how the internet is. The internet right now is a bunch of computers running across the world, mostly by corporations, which allow us to do many, many, many different things, many different websites, many different use cases, many different things, right? What blockchain is a bunch of computers that are not being run by corporations. Most of them aren't being run by corporations. Most of them are being run by individuals who are either miners or they're staking, or there's other kind of ways of running the computer. But all it is a network of computers that are all running one code. And the basics of this code say that there is a shared accounting book called a ledger, basically, that keeps track of how many coins each person has who's participating in that network. So it is just a set of millions and millions of computers that all have the same ledger on it, and that ledger is keeping track of how many coins are in each account, right? That's the idea of blockchain. When those computers are all hooked up together and they're running that code can be set up in many different ways, right? So the Bitcoin code is set up to say, okay, number one, you're going to keep track. We're all going to kind of together keep track of how many Bitcoins are in each wallet. That's one. Secondly, we're going to use technology to be able to secure that so nobody can hack it and mess with it. That's number two. But thirdly, there are properties of that code, properties of the code that programs all of these computers. So the Bitcoin code says a few things. Number one, it says there will only ever be a maximum of 21 million Bitcoins in existence, period. No more than 21 million will ever be produced. And already there's over 18 million in existence, so only a few more million to go. The second thing the code says is every 4 years, half the Bitcoin will be produced as were produced the previous 4 years. Okay? So before May 2020, 1,800 Bitcoins were produced. After May 2020, 900 Bitcoins get produced every day. It's just in the code, it's set up. And in 4 years, 450 Bitcoin will be produced. And so on and so forth. So every 4 years, half the Bitcoin get produced every day as did before. Okay? That, the ability to be able to trust the fact that the code is going to produce a diminishing supply of something allows us then to be able to trust, hey, if something is going to be in smaller and smaller supply and there's going to be more and more demand for it, even if the demand was to stay the same and the supply drops, then the price has to go up. Now, if the demand's going up and the supply is dropping, that creates a real storm where Bitcoin will have to keep getting more and more expensive in order for it to match that increase in demand and the constantly diminishing supply. Normally, when even gold or diamonds or anything, shoes, Xboxes, as soon as the demand goes up, the supply usually goes up. Because as soon as the price of gold goes up, miners start mining more gold. As soon as the price of diamonds go up, diamond miners start mining more diamonds. But with Bitcoin, as the demand goes up, the supply stays the same and actually every 4 years drops. So that's one of the big reasons why on the long term it's very predictable that the supply, the kind of the supply demand dynamics that are involved in Bitcoin will cause the price to keep increasing, especially when you're thinking of it in dollar terms, because less and less will be produced, more and more people will want it. And the curve of how many Bitcoin are produced. So most of the Bitcoins were produced in the early part of the cycle, in the last 10 years or 12 years that it's been actually active. And now over 18 million have already been produced. So there's only a few million left to go. And less are going to be produced until one day zero are produced. That's one of the reasons why the price of Bitcoin keeps going up in this way. It went from 0.08 cents to dollars, from dollars to $1,200, from $1,200 to $20,000, from now going from $20,000 to some ridiculous number this time, and then the same thing will repeat again in 4 years, and then the same thing will repeat again in 4 years. That I can definitely say. And the reason is because that is actually one tied to the mathematical code that is running on these computers that we just talked about. But secondly, it's also tied to human psychology. And this is where the psychology piece comes in. That when humans know something is about to become rare, especially something like Bitcoin, where we know half is going to be produced, logically the price should just double, right? If half of them are going to exist as did before, then price should double to kind of match that. But human psychology says, hey, this is something that is going to be valuable and in demand. So actually, I'll pay you more than double the price for it. And then somebody else comes in and goes, well, I think somebody else will pay higher, so I'll pay you an even higher price for it, and I'll pay you an even higher price for it. And instead of the price only doubling, we keep driving the prices higher and higher and higher until it gets to a point where it's overvalued and at a ridiculous number, and at that point nobody wants to buy it for that price, and then the price sharply drops because now nobody wants to buy it and a bunch of people are trying to sell it. That's where the psychology piece comes in, where the human psychology of understanding that people will want it and there's some greed in there that, I really want to be able to make more money from it, therefore I'll buy it for more and I'll buy it for more and I'll buy it for more. Another piece that comes in is FOMO, fear of missing out, because initially when May 2020 happened, the price of Bitcoin just went up just a little bit, little nudge. And then it pretty much did nothing for quite a while, for about 6 months. And then it started to kind of climb upwards, rocket upwards. So initially, when the price was very low, there was fear of even getting into the markets. Most people we're not interested in getting in because we were all fearful of, hey, nobody's buying it. Why should I buy it? I don't want. I'm scared that this might still be worth nothing. Who knows? Then when the price starts to go upwards in a significant way, most of us make the mistake of thinking, oh, it's going up in price. Now I want it. And then because we're buying it, the price goes even higher. And then it manifests itself. And we go from the fear of entering the market to fear of missing out. And we start to buy it because we have the fear of missing out. And once the price gets even higher and starts to go really parabolic, then that fear starts to turn into greed, because people start to see, oh my God, there's people making a lot of money. I've made a lot of money. Oh my God, this is great. I want more. I want more. I just turned X amount of money into a ton more money, and now I want more. I want to turn it into double. I want to quadruple it. And that greed then becomes one of the blinders that you put on, where first you didn't want to buy it. First, when it was really cheap, you actually didn't want to buy it. You didn't want to enter the market, which is the wrong thing to do. That's when you should have bought it. Then you FOMO'd your way in. You had, when the prices started to go upwards, you were like, I want it. Actually, when the prices go upwards, you should not think about buying it. You should actually think about selling it. But anyways, the prices started to go upwards and you start to get fear of missing out. So you entered. Again, fear. Then when the price actually goes up in a significant way and starts to go parabolic, then you think, I want to keep holding it because I want more and I want more. And then one day the price crashes back down again, and that greed that you've been holding on to actually becomes your enemy, because you should have actually sold it at those high prices, because now nobody wants to buy it. And then the price crashes back down and you're left holding an asset that you could have made a lot more money on. So that's where the psychology piece comes in. At the very bottom, you have fear. Somewhere in the middle, you start to get fear of missing out. Somewhere else, you get greed. Then you start to go into thrill and euphoria of how much money you're making. And then that thrill and euphoria keeps you blinded while the market moves against you and drops the price. And you're left holding an asset which maybe didn't make you very much money, or you could have made a lot more, and then you didn't end up making it. So understanding that part, understanding that Bitcoin has code. This code is running on computers, a network of computers. That code says that every 4 years, half the Bitcoin is going to be produced. Half the Bitcoin being produced is going to drive the price upwards. I want to buy Bitcoin. Ideally, you want to buy it even before the halving event happens. If you know it's going to happen every 4 years, then ideally, before that, you should buy it, because after that, the price is going to go up. Okay? And ideally, you should know enough about this market so you never FOMO into it. Excuse me. You should never have fear of missing out. That shouldn't be the reason why you enter. The reason why you enter should be knowledge, and you understand even just these fundamentals, but also you understand what you're putting your money into, because you never want to put your money anywhere you don't understand. You want to control your greed, that when you do make a decent bit of money, have a profit-taking strategy. Understand that at that point, you really want to think about making sure that you're not risking any of your own money. If you've already made a decent bit, take out your initial investment, secure yourself. Then once you start to see the market is going just parabolic and price action is going to crazy numbers and it's unsustainably fast, then you really should start thinking about how to get out of the market. Instead of holding on to that greed like, I want more and I want more, you should think, oh, this is crazy. Everybody's entering. This price is going up daily or weekly in a way that is completely unsustainable. I want to at least think about pulling some of my investments out of the market, if not all of them, depending on what your strategy is. Okay, so that's a good set of fundamentals to know. Another one that tends to be really important is understanding that you need to have a plan. You need to have a plan, because if you do anything in life and you just have no goals, you have no plans, you have no knowledge, and you go into it, you are much more likely to fail than if you have a plan. If you set out a clear, concise plan that's informed by knowledge, and it covers all the pieces necessary for you to be able to participate well, for you to be able to succeed well, then you really increase the likelihood of you actually succeeding. where compared to somebody who just kind of goes in and hopes that they'll figure it out, or I'll kind of learn about it on the go, or maybe you have a plan but it's all in your head and you're thinking, oh, it's okay, I'll be able to control my psychology, I'll be able to keep all these complex pieces in my head. That's not the best idea. Write it out. One of the best kind of secrets that I learned, I used to watch all these kind of motivational videos and really try to learn, like, how do I improve, how do I achieve all those things in life that I always dreamed. And one of the messages always was, write down your goals. Write out your goals. And I would always say, like, okay, that it can't be that simple. You want me to just write out my goals in journal and stuff like that? Tell me the secret. Tell me the real secret. And all of the greats would constantly say, well, write out your goals, be specific, focus on them, visualize them, go take action, and then you can do them. And I would say, well, it can't just be that I write down what I want and what I want to do, and then I really focus on it and visualize it, and then I take some steps towards that, and then what? That's it? Where's the secret? If you've seen The Secret, you probably even wondered, well, sitting here and visualizing all this stuff isn't really going to work. Even if I write it down, it's not really going to work, which is true. If you just sit there and write stuff down, and then you just sit there on a couch, wondering where all the things that you wrote down are, they're probably not going to come true. But you do have to write it out, focus on it, understand it's something that has a step-by-step kind of plan and procedure for you to go do it, and then go do it. But if you do all of that, you have a plan, and then you execute on it, then you are part of a very small percentage of the world that actually does that knows what it wants, writes it out, and then goes and does it. If you don't have a plan and you just go and start doing it, how do you even know what you're doing? If you do have a plan and you don't go do it, then it makes perfect sense that you're not going to get what you want, right? So having a plan is a huge part of it. Another big piece is understanding that things move so quickly in this market that you have to participate in it in some way. You have to stay on top of the knowledge. I'm not saying you have to learn everything. There's too many things going on at once that it just becomes overwhelming to learn everything, but you have to stay on top. You have to have some kind of community or some kind of knowledge base or some expert for you to be able to participate properly. If you don't have the time to do that, hire an expert. That's what I do. I actually help corporations and help individuals be able to stay on top of the market without spending all their time on it. And for me, I'm spending all my time on it. So it's easy for me to then pass that out to as many people as I can and help them understand and help them make informed decisions. Otherwise, you can just do that on your own. It doesn't take that long. You can spend maybe an hour a day, 5 days a week, just kind of reading news and following information. We have a resources section on our website that really gives you all the resources, not all of them, but a lot of resources necessary for you to be able to be informed and really learn. Because in the end, if you don't know what you're investing into, you will lose money. That's almost always a one-to-one. Always invest in what you know. But even in the learning process, there's a very kind of important concept you have to keep in mind, that these are unregulated markets. So anybody can just manipulate the markets however they want. And one of the best ways, because if this is tied to mass psychology like we talked about, then the way to manipulate the markets is actually to manipulate the psychology. Because if fear is the reason why you'll sell, or the fear is the reason why you won't get in, or fears of missing out is the reason why you will get in, then somebody who wants to profit from that could actually cause those emotions and those kind of patterns in you to actually take advantage of you. So what ends up happening is you'll hear news and you'll hear China outlawed Bitcoin, and then you'll see the price drop, and then later on the price kind of recovers. Or Elon Musk no longer wants to accept Bitcoin for his Tesla, and you just see the price take a dive and the whole market freaks out and everybody goes crazy, and you see a 35% dip in prices and people think, oh my God, I just lost 35% of my money. That is actually part of something we call FUD. FUD. Fear, uncertainty, and doubt. FUD. It's a very common practice in this market. We even gave it a name, cute little name, FUD. But it's a way to manipulate the market, Because if you can cause fear, then people will panic sell and sell out of fear. And if people sell out of fear, the price goes down. And if you want to buy, especially the big money out there, we call them the whales, the people with tons of money, they actually have the ability to be able to cause certain events to freak out the people who don't know what they're doing, who didn't come in with a strategy, didn't come in with a plan or knowledge, and freak out those people and actually cause them to be able to sell. And then that person who wants to buy in buys. And anybody who understands market psychology actually understands that this is something that's very common in all markets. You know, you can release new rumors and you can cause prices to fluctuate. It's just in cryptocurrency, it's very pronounced. So you will see these regular 30% drops constantly. That price will go up, then 30 to 40% drop. Price will go up, and then 30 to 40% drop. So that's another piece to really remember. 30 to 40% drops are very normal in this market. In any other market, that's called a recession. It would signal a complete disillusion of the entire kind of market narrative. But in this market, we call that a Tuesday. I'm just kidding about that, but we just call it a normal day. When the prices are rallying upwards and things are going up, the next thing you should expect is that the price is going to drop 30 to 40%, because that's a healthy part of a market. Things can't just go from standstill to some ridiculous valuation without having these kind of stairs where it goes up and then it drops 30 to 40%, goes up and drops 30 to 40%. And then in the end, one day it drops 40, 50%. If it drops 40%, start to really pay attention. If it drops 50%, then we really know there's something different going on in this market. If it drops more than that, then you almost certainly know that we've reached the other side of the peak, right? So be ready for that. Be ready to actually participate in a way. So when the price drops 30%, what you think about doing is buying. Obviously, you have to make sure you have done your fundamental analysis so you understand where the projected peak is going to be. That's definitely, you don't want to just keep buying every single dip right up to the point where the peak happens, and then even on the other side, as the things are dipping, you're just constantly buying. You could do that if you're playing a 5 to 10 year strategy, but if you're trying to kind of increase your gains and maximize your gains between the shorter period, that's not exactly something that's the best thing to do. But be ready for it. Be ready that the price is going to drop 30%. In that situation, there's fear being created that they want you to sell. It's FUD that is manipulating the market in a way so that you sell. And if you don't sell, the price will go back up. And that's why when we say hodlers or people who are holding on for dear life, they actually are. It's one of the best strategies, is because if you just buy it at a low price and you hold through all of these dips, eventually it does get up to a crazy place, and then you can actually take profits at that point. Another kind of fundamental piece to remember in this market is, if you are going to enter this market, it's going to be a very emotional experience. It's going to be very emotional, because if it goes up, you start to get really happy. And then when it drops 30%, you feel like you just lost a bunch of money. And that's a very, very important thing to remember. Let's say you put in $100,000. When it goes up to $130,000, you didn't make $30,000. Okay? When it drops from $130,000 down to $70,000, you didn't lose $30,000. Okay? When you put in $100,000, the only time you will lose $30,000 is if it goes down to $70,000 and you sell it, right? You sell it and then you pull out $70,000. Now you've actually lost $30,000. But if you put in $100,000 and it goes up to 130 and comes down to 70, and then it goes up to some other price, in that whole process, you never made or lost any money. You were just sitting in the market. That's a key thing to remember. When it goes up, you didn't make any money. When it goes down, you didn't lose any money. It's when you buy or sell it that it actually makes the difference. When did you buy it and when did you sell it? So if the market is going to have these stair steps, and sometimes it goes up, sometimes it goes down, but on the whole, it's going up, and you hold for a few months or years or whatever your strategy is, It's when you sell it that you decide, hey, this is how much money I made, and this is how much, or this is how much money I lost, right? So the smart thing to do is do not sell until you're in profit. It's simple. Do not sell until you're in profit, because even the people who bought the very top of the market, the most expensive point of the 2017 cycle, which was $20,000, around $20,000, those same people, if they just held it for 4 years, would now be looking at $40,000, $50,000, $60,000 Bitcoins. So if they just didn't sell it, they just didn't panic and actually held on to it, they would have still been in profit. Whenever the market reaches a new high, 100% of the people who have ever bought Bitcoin become profitable, because if they would have just waited to that point, they would have made money. So the point is, don't sell it until you have profit. Even if you end up buying late by mistake or something happens because you didn't have a strategy, please don't just sell it. Every 4 years, the price is going to go up. And if you didn't make money this time around, you can make it next time around. Now, obviously, you should be informed enough and understand that you want to participate in this cycle as an intelligent investor. And intelligent investors would know the market is getting too hot and market is getting too high and too overpriced. I want to keep using simple terms. I want to make sure that I'm not using too many market terms. That's why I kind of repeat myself in simpler terms. But the market price is getting too high, and you definitely want to, be investing when the market is much lower, when the prices are much lower. So how do you do that? What do you look at? How do you know the price is too low? How do you know the price is too high? So there's a few different good things to know on that front. It's really good to understand how to read charts, it's called technical analysis, where you can see price action and you can start to infer from the price action, what is the market telling you? Are the buyers in control? Are the sellers in control? Is there too much volume? Is there too much sell-side pressure? So you can actually learn how to read the price action and understand, hey, are things too overbought or are things underbought? And is it cheap to buy it? Is it expensive to buy it? That's one thing. It's complex. It's not really for everybody. Another way that you can do is you can actually get an expert that can actually walk you through that process. But again, you don't want to just depend on somebody. You don't want to just, hire me and say, okay, you just do this. I don't want to learn anything about it. Whatever you say goes. No. Anything any of your experts actually tell you, make sure you understand it. Make sure you ask questions. Make sure you do research on it so that you understand what it is. Because if you're going to be the bank, you're going to be your financial advisor, you're now going to be doing all those things that traditionally have been done by other professionals, then it's important for you to always make sure you understand what's going on. Because, I can advise you on stuff, but the decisions are all made by you. I'm not I definitely am not an advisor, a financial advisor. I can actually give you the knowledge for you to make the decisions, but I can't tell you do this or do that, right? Even when I'm working with clients, my job is to make sure they have all of the resources necessary to be able to learn and make informed decisions on their own. I can't make decisions for them. That's just not my job. That's not who I am. That's not what I do. So make sure you have the right resources to be able to do that. A third way of doing it is actually something called on-chain analytics. So that's one of the really big ways that I'm able to show clients what it is that is going on and really be able to inform them for the best kind of decision making, where, blockchain and crypto and all this stuff, it's open to the world. So anybody can run analytics on it. And if you understand which pieces to look at, then you can really understand how to see live what's going on in the market. How many people are buying it? Who's buying it? Where's the price going? Where's the money going? Where are the coins going? What does that mean? What's happened in the past? What can we infer from that, right? So all those kind of things kind of come together to build this story, build this picture that allow you to really be able to understand which decisions to make and when to make them. When is it cheap? When is it expensive? Is this the top? Is this not? Of course, anything can happen, but having these kind of pieces all put together really give you a cohesive story that allow you to make decisions in an informed manner. And having somebody who can actually walk you through that process, or even just bring you those stats and show you and help you understand them, goes a very, very long way in you being able to make the decisions that are the right ones, right? Because acting from that place of analysis and data and understanding and technical analysis, that really is the way to make sure that you're not acting from a place of psychology and emotion, right? You're not acting from a place of fear and greed and euphoria. You're acting from a place of knowledge and data and objective things, not subjective things. So knowing all of these pieces together hopefully will give you a better understanding of how to make sure that you learn about them. So okay, so now a few more things is, how do you learn? A lot of people, when you're new, it's difficult because you just go if you go into Google and search, there's 1,000 different things. Even YouTube's okay. There's a lot of people on there just talking about stuff that gets a little confusing. So there are some resources on YouTube that I really like, but I don't recommend that beginners just go on there and just start kind of watching everything. Simple things like, what is blockchain? What is Bitcoin? How does blockchain work? What does Bitcoin do? Those kind of things, it's really good to have something like YouTube, where it's a visual medium. It really shows you in diagrams and things. You can watch a few different viewpoints and it really helps. That is a good place to have. But making sure that the people who you are actually listening to are vetted experts. And by that, what I mean is they've proven over time that they are capable of giving the right information, and they're proven by actually giving the information previously, and people have been able to confirm that was the right information, or it was helpful. Or you can have a bunch of different resources. When they all agree on something, then it's really likely that that's something that you can rely upon. And of course, you do your own research, so you know that to trust them, right? So that's one way. Another great way that I like to make sure beginners get in is reading books. I know that's old school for a lot of people, but understanding the fundamentals of cryptocurrency, it's really, really good to read books about what is blockchain, what is cryptocurrency, where does it fit into the bigger picture of things, why is it important, why does it have value, what are network effects. There's a bunch of different things that could really help you. One great resource I like to have is it's an app called Blinkist. We actually, on the website, we have an offer for 1 month free of Blinkist under the resources section. You can sign up for this app, and it actually breaks books down into 15-minute summaries, basically, and they provide audiobooks as well, audiobook versions of these summaries. And if you just go in there and then you search the words blockchain, cryptocurrency, Bitcoin, and Ethereum, and you just read the books on there, and they're 15 minutes to be able to listen to really quick. That really gives you a decent bit of fundamentals to help you understand, okay, where did this come from? What is it? How does it work? How can I kind of understand, have a mental model of what it is? That's a great place to start. And then, of course, reading long-form books is another great place to start. Even for news sources, traditional news sources are part of that FUD narrative, where your Google News and MSNBC and BBC and all these places, they are part of the networks of mainstream media, which are very easily manipulated by the powers that be. And the fact that you're getting some news on there usually, oftentimes, can be a signal that it is being put there for a reason. It's being manipulated in a way to make you act in a certain way. So I don't really like the traditional news sources, but there are, again, a bunch of resources on the website that you can find where these are crypto news sources, and they do tend to be a lot more vetted in their approach, and they do tend to put news that is not so one-sided. It actually gives you a balanced viewpoint. I'm not saying that there's no news on there that's being manipulated. That's across the market, but at least it gives you a better source of news. So that's things like Decrypt or CoinDesk, or there's a few other ones that are on the website that you can find under the resource section. So using all these things together, and of course the video resources, there's a great one called Real Vision. Real Vision is one of my favorites because it is a little bit more advanced than the beginner, but it's a great way of. So it's created by Raoul Pal, one of the visionaries in cryptocurrency, but also he's a an ex-Goldman Sachs exec who really brings together traditional finance and the viewpoints and the macroeconomic viewpoints to the cryptocurrency world and ties it together. And RioVision is his platform that allows you to be able to hear the viewpoints of financial experts mixed with cryptocurrency experts and really get a high quality version, reliable version of whatever's going on in the markets, and oftentimes understand the details of each project. So these are just some things that I want to make sure that you know and that you're familiar with that would really help you on this journey, and just understand the fundamentals of what's going on here. So hopefully that added some value to your life. Thank you so much. Until next time, I'll see you. Bye for now.